Hello, everybody. My name is Alesh Eisner, and welcome to the Canadian Money Talk, the channel about Canadian investing and personal finance. Please like and subscribe. I record 2 videos per week, so make sure you ring the notification bell to get notified each time one comes out. This is my thoughts on market happenings for the week ending December 23rd, 2022. Looking at the market indexes for the week, the TSX and Dow Jones were up slightly. The S&P 500, Nasdaq, and Russell 2000 were down for the volatile week. Gold and oil were up for the week. Oil will be boosted a little more in a few weeks when the US stops taking oil out of its strategic oil reserves, and some oil will come off the market. Also, because of the traders being on holidays, a small amount of money can move markets for these 2 weeks, which resulted in significant ups and downs this week. This reason for volatility will go away in January. Looking at Canada, we had a consumer price index reading on Wednesday. The good news was the core CPI month over month increase was zero, where the forecast was 0.2%, which the market liked. The headline CPI, when you add in the food and energy, which are more volatile, was higher than expected, but still lower than the previous months. So overall, that was a good CPI reading. The Bank of Canada may raise one more time in January by 1/4% and then be done, or even stay with the interest rates where they are in January to let the previous interest rate hikes take hold. They will not raise as high as the US because of Canada's indebtedness, since higher rates would cause some bankruptcies and eventually cause the economy to slow down even more than expected. Financial institutions tend to do quite well once central banks stop raising rates because the fear of a hard landing and significant recession will subside and their margins have improved. My credit union raised the rate it charges me on my home equity line of credit by 3%, while the high interest savings account only went up by 1.4%, so their margin improved. Canadians and their mortgages typically only face problems in two cases. One, when variable rate mortgages hit their target rates and the owners need to start paying more per month. And two, on renewal, where 13% of Canadian mortgages will renew in 2023 and 12% in 2024. The higher rates would affect the renewals of fixed rate mortgages. Interest rates drive debt servicing costs, and as those rise, that becomes a leading indicator to credit losses, which affect the banks. This would be even worse in a recession with its rise in unemployment. Turning to the US, Goldman Sachs is planning on laying off 8% of its workforce. Semiconductor maker Micron, squeezed by declining demand for personal computers, said it would reduce its workforce by about 10%, while also suspending bonuses. Two big earnings reports on Wednesday lifted investor spirits. FedEx revenue fell shy of Wall Street's projections, but earnings came in above them. Nike, meanwhile, easily beat estimates while making headway on its inventory clearance efforts. The sports apparel maker and retailer also enhanced its revenue outlook while posting improved inventory numbers from the prior quarter. Nike, like other retailers, has been mired under merchandise glut, largely due to supply chain snarls, so inventories are still much higher than a year earlier, and they're cutting into margins. But some aggressive clearance work, including a big shift of products to wholesale channels, has helped Nike feel like it's past the peak of its inventory woes. Now let's take a look at Amazon. Amazon thrived during the earlier days of the pandemic. How could it not? People were largely stuck at home, so they shopped a lot online, spending stimulus checks and money saved from not commuting on necessities and fun items alike. But that didn't last, even though COVID's still out there, and now Amazon's shares are back to where they were at the start of the pandemic. The stock has fallen nearly 50% this year, and it's on pace for its worst year since 2000 during the dot-com crash. There could be more pain to come since Amazon's guidance for the holiday quarter came in well below what Wall Street was expecting. Turning to electric vehicles, auto executives are a lot more bearish on short term prospects for the electric vehicle adoption than they were a year ago. For 2030, the median expectations for EV sales in the US is 35% of the market for new vehicles, according to a KPMG survey of 900 industry executives. That's down from 65% last year and well below the Biden administration's goal of 50%. The new reading reflects concerns about the high cost of materials to make EVs as well as broader economic worries, such as higher interest rates and inflation. Quote, there's still a sense of optimism long term, and yet, most importantly, there's a sense of realism in the near term. You see this realism throughout the entire survey, end quote, says Gary Silberg, KPMG Global Head of Automotive. Another day, another grim scrap of data from the US housing market. Home sales stumbled a deeper than expected 7.7% in November from October, marking the 10th consecutive month of sales declines in the US real estate. And about 3 weeks ago, the US Fed launched its digital dollar pilot program. There was little fanfare, but it's a massive development that could speed up business transactions. The idea is to simplify interbank settlements using simulated digital tokens. These tokens represent customer deposits. The banks will also run the pilot as a simulation next to existing transactions, mimicking real world transactions and following current legislation to test the legal viability of a CBDC. Business transactions using virtual currency hope to clear transactions faster, and a Fed coin could dramatically change the pace at which business happens. The US personal savings rate is on track to average just 3.2% for 2022 as a whole. The US Commerce Department reported a savings rate of just 2.4% for November, higher than expected, just slightly above the second lowest monthly reading since 1959. The majority of households are now dissaving, racking up debt to try to maintain their standard of living. Evidence of this can be seen in a 15% increase in revolving credit in the year ended in October 2022, according to the Fed. And lastly, some bits and pieces. Outside the tech industry, the threat of a recession has had a much softer impact on US wages and unemployment than economists expected. The Labor Department reported that unemployment remained low in November at 3.7%, the same as the previous month. Wages were up 5.1% year to year, suggesting that an economic downturn probably won't have the devastating toll on the labor market that the Americans expected in connection with the Great Recession in 2008. Overall, workers probably won't have to relinquish all their power they've gained over the last few years. Though the Great Resignation may seem like it's winding down, PayScale, an American compensation software and data company, says companies that ask employees to return to in-person office work are at risk of losing talent, even with the potential of layoffs. Quote, workplace flexibility has been shown to improve employee satisfaction, so rescinding this perk can be a major factor in employees' decision to resign, end quote, PayScale said in its news release. Turning to China, China has experienced a new COVID outbreak as a result of its reopening efforts. The Chinese population is undervaccinated because isolation was the method of fighting COVID. And Bank of Japan allowed its 10-year bond rates to rise by 0.5%, which is a change of the regular policy of stimulating its economy. They are the last bank to start raising rates. And looking at next week, there's no significant reporting of Q3 because that reporting is done. Economic events next week on Tuesday, there is the US Housing Price Index. It's a very slow week because of the holidays. So that concludes my thoughts for the week, and I will wish you happy holidays. If you have any requests on what you would like me to cover in future videos, please put that into the comment section. Please like, subscribe, ring the notification bell, and may you have a profitable day.